Hi, this is Raghav. Welcome to Insights on Personal Finance. In this video, let's get an overview on mutual funds. So what exactly are mutual funds? A mutual fund is nothing but an investment vehicle which is owned by a company called Asset Management Company, that is AMC. Their job is to collect money from various investors and put it for investment in specified products. Right? There are many types of many categories within mutual funds, and they collect money for each category and each type of mutual fund, and they invest on behalf of the investors, right? And obviously the investments will yield some results, that is, the appreciation will happen. That appreciation the investor can enjoy. So basically these are professionally managed by the fund managers, who are qualified people to manage the funds. And you as an investor can invest money at any point of time and withdraw the money at any point of time. So in order to do this, the company charges a fee in the form of expense ratio to manage these funds, right? Every fund has to be managed by a fund manager and his team. So there are employees involved and costs involved with those employees and other costs to manage these funds. So that's why you have to pay a fee, which is generally about 1 or 2% depending on the type of fund that you are buying. So this is the overall idea about mutual funds. So it's very useful for people who want to invest specifically in stock markets, but they don't know how to identify stocks and invest. For them, mutual funds is a good approach, so that the fund manager takes care of selecting the stocks and all that, and people can invest through the mutual funds. So what are the types of mutual funds? There are many types of mutual funds. Some of the popular ones are equity funds. Basically these are the funds where the underlying asset is the stock market stocks, the stocks that are traded in the stock market, right? Obviously stocks means the prices will go up and down every day. So the mutual fund value that you invest in mutual fund will also go up and down every other day. So it's called as volatility. So the equity funds will be generally very volatile and generally have higher risk, in the sense the money value will keep going up and down. So if you stay invested for a longer period of time, let's say 10 years or above, you will get very good returns over that time frame. There are other types of funds called debt funds, which doesn't invest in the stock markets, but they invest in company fixed deposits, bonds, government bonds like government securities, etc., where you will get a fixed amount as interest from these organizations. What the funds will do is they will pull all that interest and give it to you in the form of appreciation of your fund value, right? So when you invest, let's say you are getting 6% interest. If you have invested 1 lakh 1 year before, the fund value will increase to 1,06,000 after a year. So it indicates a return of 6%, right? So this kind of funds are relatively very safe. They are not very volatile like the way stocks are there. So, but they will give very reasonable returns in line with the bank fixed deposits. So it will be probably slightly a little more than the bank fixed deposits. So this is suitable for very conservative investors who are not comfortable with the ups and downs of stock markets. So there is also other types of funds called gold funds, which will invest in physical gold. So gold also can go up and down, but it doesn't go up and down like the way stocks go. So some people prefer investing in gold. This is another way of investing in gold. Definitely buying jewelry as an investment for gold is not a right option, because jewelry involves a lot of other costs like making charges, which are very high. So if you want to invest in gold, go for gold funds or gold ETFs. But if you want for consumption, like for that you can buy jewelry. Remember, buying jewelry is not an investment. People confuse that buying gold jewelry is an investment. It is not. And There are different types or categories among the mutual funds. One category is called exchange traded funds, which are very popular in the United States, and it is slowly getting popular in India also. Basically, it is like buying. You can buy and sell a mutual fund like the way you do stocks through a broker, right? You can log into your website or you can use broker's mobile app and buy and sell mutual funds at real time. That is during the stock market trading hours. Those types of funds are called as exchange traded funds. There are other types of funds which are not exchange traded. That is, you buy the fund on a date, and the mutual fund company will allocate units for you at the end of the day, and you will get to know how many units got allocated at what price the next day. So within this, they have two categories. One is called active funds and passive funds. Active funds is where the fund manager will decide which stocks to buy, when to sell, when to buy, etc., and which stocks to buy also. So he is the main decision maker there. So generally, active funds will have a slightly higher cost because it is actively managed by the fund manager, but most of the times they do give higher returns. When it comes to passive funds, there will be a fund manager. However, he doesn't make any decisions on selecting the stock, right? So it is selection of the stock is based on an index. An index is nothing but a bunch of stocks decided by the exchange. They have different indexes. For example, we have Sensex index, which is having the top 30 traded stocks in terms of volume and market capitalization. Similarly, we have Nifty 50, which is traded in stocks, which is typically an index of the National Stock Exchange, that is NSE. So these indexes or indices, there are many such indices. These are popular indices, Nifty 50 and Sensex 30, and also Nifty Next 50, which is the next 50 stocks. These are some of the popular ones. Passive funds will invest in the stocks belonging to a particular index. So the fund manager doesn't have to do any job of selecting the stocks because it is already a part of the index. He just has to buy and sell depending on whether he is getting inflow or outflow. That is, when more people invest money, he has to buy. When more people sell or redeeming their units from the mutual funds, he has to sell it. So that's all. He doesn't have to do any stock selection. That's why the cost or the expense ratio of these funds are much lower compared to active funds. So both have their own plus and minus. The index funds will give you, the passive funds or the index funds will give you the returns in line with the index. Apart from that, you need to know there is something called as a regular and direct plan. If you buy a mutual fund through an agent or what is called as a distributor, mutual fund distributor, he will get a small commission. So you will be actually paying a little more when you go through an agent. This is called as a regular plan, but the agent is supposed to compensate that by giving you proper advice on which funds to buy and which funds to hold on. So if you don't want an agent, you can do your own research. You know what to buy, from which company to buy. So you can directly buy through the company's website or their app. If you do that, that type of investment is called as a direct plan. So here the cost will be slightly less, like about 1% or something. It will be less. So this is suitable for people who can do their own research. So as like the stock price, mutual fund will also have a price which is called as net asset value, which will vary on a daily basis, right? Depending on the underlying stocks or bonds values, it will change on a daily basis. So these are all very basic things that you should be aware of regarding mutual funds, and there is a lot more things that you can learn from many of the websites that are available. The most popular ones are the mutual fund Sahihi website and amphiindia.com websites. So you will get a lot of information on these websites. Please go through that and have a basic understanding of what is a mutual fund and what are the different types and categories of mutual funds, and how you can choose them for your investment. So this is all about the overview of mutual funds. And I hope you found this video useful, and I thank you for watching.